The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, the corn market found a higher number for the third day in a row. And wondering here, it was a slight gain, but can we continue this rally, or are we going to run out of steam? Wheat, though, did take some profits for the most part on the day, and the cattle trade took some profits as well on Wednesday. Joining us now to take a look at the markets, pleased to have Mike Zuzolo with Global Commodity Analytics with us here on Market Talk as we spend time at Commodity Classic. Mike's back in his office in Kansas enjoying a nice wild temperature swing. Mike, we talked about that Wednesday morning on AOA. Has the temperature gotten any better as we've gone through the day, Mike?
Not much. I mean, we're up above 20 degrees right now, Jesse, but we essentially went from 75 degrees at noon yesterday to about a zero wind chill by this morning and late last night. And so I don't think I can remember ever a move in extreme temperatures like we saw. And I really do think that the hard red wheat picked up on that as we closed out the session. And I think it made a distinct move away from the soft red wheat. And I say that because the way the market structure closed up ahead of the delivery, and as you and I talked about this, you brought it up on AOA Wednesday morning as well about the delivery coming in on March futures. But you notice that March hard red wheat on Wednesday's close, trading upwards of $5.95, broke through $6 before the close. But settled back around $5.95. Then the May contract is sitting around $5.80, and then the July hard red is sitting around $5.70, $5.75. So you've got an inversion in all three of the contracts as we head into delivery. So I'm going to say that I think the hard red wheat picked up on this cold weather, and that the delivery process is suggesting that the futures market's too cheap compared to the cash market out there. So that's something to really watch to answer that question you just asked. Can the corn continue to go higher?
Well, and I want to start and stay with the wheat here a little bit because I think that's a big catalyst. And I know our first chart we have on the video feed today, you mentioned this to me Wednesday morning as well. You're kind of watching EU wheat and some of the correlations there. And we got a chart looking at EU milling wheat futures versus US SRW futures. So, I mean, talk about some of these correlations you are watching right now. Can we have wheat continue to maybe be a leader for a rally here in the grains, Mike? What do you think?
I think we need it, and I think we need it in the soft red eventually, Jesse. And I want to say that this is not just a weather market about hard red wheat and these cold temperatures. You know, the soft red wheat belt starting Wednesday night and again on Thursday night are expected to get into the 23, 25 degree temperature lows. And my understanding is there every bit or close to every bit is grown and breaking out of dormancy and prematurely growing too fast for this time of year, like the hard red is. So places like Olney, Illinois, which would be south of Route 50 or right on Route 50, you know, bottom third of Illinois, where most of the soft red wheat is, looking at 2 nights of 25 or below temperature. So I want to say that soft red wheat can come in and pick up the slack as long as the delivery process doesn't derail it. And I think it's necessary because this chart shows us the European wheat in the black and red bars, the U.S. soft red wheat in the purple bars. They've come together. They're the same price now, with the European wheat futures on Wednesday sinking to their lowest level since July of 2020. So talk about a leader to the downside, and that's because of not just the Black Sea prices, but wrapped up in that is the currency market, the Russian ruble, and some of these other currencies that are keeping the European and U.S. wheat trimmed in terms of demand. And I think this is where the inflation data that came out Wednesday morning showing bigger than expected inflation, the one the Fed looks at the most. And I think that already started to get the Fed governors, some of them talking about how they haven't done enough on inflation and killing that inflation beast yet. So that's why I want that wheat to really shine as we close out this week in SRW, and then I think we've got something to go with.
Well, and in terms of looking for a wheat-led rally, this corn market did its best to kind of keep the uptrend 3 days in a row on Wednesday. What are you seeing right now on a continuation chart for corn here for the week? And I mean, just your thoughts overall with this corn market rally that we've kind of started since we set those lows on Friday.
Yeah, kind of dovetailing what we just talked about. That's SRW corn spread still dancing around $1.60 premium to the SRW. That's a really nice number. And if we go any higher than that, then we should be able to attract the higher soft red wheat price with a higher corn price, because that's a pretty wide spread. So having said that, if we can get wheat on board, I think we can go above that first green resistance line, which would be right around that 420, 421 and a half level. Get above 4.25 in March wheat, and I'm sticking with March because we're going into delivery, and the March futures to me equals the cash in Chicago essentially, or the cash along the Illinois River south of Chicago. So I want a 425 close in March wheat, March corn. Then I think we can get back to that second green line, which is going to be right around that 460, 465 level. That gets you real close to my current undervalue level of 472 and a half. That line right there, that number right there, that's the number I say to the world, based upon supply demand fundamentals and the macro fundamentals, we shouldn't have gone any lower than 472 and a half. That's my take on the market. And I think that's especially pertinent as we get into the next round of weather for South America. So a lot hinges on this price action right here, and we're trying to put Humpty Dumpty back together again.
I'm glad you brought up weather in South America, Mike, because I'm hearing a little bit of chatter that some of these longer range models in March are trending a little drier for Brazil. So let's focus on some of that. I know you have some analysis here to take a look at as well in terms of the South American weather outlook. Are you hearing some of the same? Are we maybe potentially looking at a weather story for safrinha corn?
Yeah, we've had two big crop reductions in percentage terms from two significant private firms in soybeans this week. We have not heard much out of the corn, and that got me looking at the corn, and especially, as you say, the second crop, safrinha crop corn, which is about 80% of the production of the total crop. Well, that production of safrinha corn is very concentrated in Mato Grosso do Sul, and I think Paraná is another province, and maybe a fourth smaller province. That those areas make up a huge percentage of the safrinha corn crop. And as you drill down in this chart, you're looking at the major provinces of corn in Brazil in the top left map of Brazil, where they're highlighted in red by province. And then below that is Mato Grosso, and that's the concentrated area where you're talking about right in the center south and southeast area of Mato Grosso is a huge amount of the production of second crop corn and corn overall, Mato Grosso being over a third of total corn production for the whole country. So if you follow that Mato Grosso map to the right and look at the charts, the cumulative precip for Mato Grosso right now for 23-24 crop is almost a whole standard deviation below the normal. And last year was just a little bit below normal, but we are really starting to dry out now as that second crop corn gets planted, and seasonally it gets very hot very fast in that part of the country. So I'm on track, Jesse, for lowering my overall production number in the Brazilian corn crop substantially, maybe 5, maybe 7% in the next 10 days if this weather doesn't turn around, because it is a critical phase right now. And I think the market kind of walked past the graveyard, assuming that things improving in Argentina meant we didn't have to worry anymore.
Or whistle across the or past the graveyard potentially. Another map here as well, looking at this precip forecast for Brazil, and I think you can kind of just add this on to what you were talking about there, Mike. I mean, it's looking like there's maybe a story here.
Yeah, I think there could be. I think I would equate this pretty similarly to last year in the United States of a 2012 type scenario developing going into the later half of June and into the July 4th holiday, and how we just got completely saved by having a terrible crop. This dry channel that I've been keeping track of for the last 2 months It's been fading in and out, but it's really never gone away in terms of what color of brown it's been. Now it's starting to get into the deeper browns. You're talking about 50, 75% less than normal precipitation over the next 8 to 14 days if the CPC forecast is correct.
Soybeans, I know we get a lot of soybeans harvested, but you mentioned some of those private forecasts have dropped some of their soybean numbers in South America. Do you think we could see maybe a little more of a soybean type of rally here in these grains if this weather story continues to trend the way it's trending, Mike?
I do, Jesse. I've talked to clients about this in depth pretty much for the last 4 or 5 months. I don't want to fight a bean rally if it's led by corn and wheat. That's really the bottom line. But beans are not the place to be long, in my opinion, right now in relation to the market premium that we've had in soybeans to date. We have taken some of that premium out, unfortunately, during the base crop insurance price factoring month of February. We've drained some of the November premium away from the D's corn. But as a fundamental supply-demand fundamentals, with the world wheat stocks to use levels still at 2014 levels in terms of that's the tightest we've been right now for the last 10 years. And U.S. wheat ending stocks, the second lowest since 2014. If this weather keeps up here in this country, I still think wheat is the main market that a weather rally should happen. But if wheat and corn can pull it together here and Humpty Dumpty gets back on the wall, I would expect the soybeans to follow. And I love being in puts right now when it comes to the soybeans, because I'll just roll up the puts if we get another 40, 60 cent rally. And then I'll feel like, okay, now I've got my 23 bushels covered. Let's start on 24. So that's the logic I have in this market right now, because the trade's been very well aware of, this week included, of lower soybean production numbers. They've priced that in. We haven't even started in corn, if you ask me.
We are talking today with Mike Zuzolo from Global Commodity Analytics here on Market Talk. Mike, let's go over to livestock. Cattle futures, we took a little profit, it looked like to me, in both fats and feeders on the day, Wednesday. Do you agree with that? I'll just kind of start there, but then also we got a couple good charts to look at, starting with the monthly feeder cattle cash index. So, I mean, your thoughts there just to start. Was it kind of a profit-taking, technical type of day in cattle Wednesday?
I think it was technical in that the funds, I think, are unwinding their long feeder short corn positions, Jesse. I think this is a very big part of the puzzle for why corn is going it alone, in part for right now. And I think South American weather could be another element. We'll know that here, I think, more in a week or so. But don't get caught up in the idea that we have to make new highs in feeders if we don't have everything going in the right direction for us in terms of how the funds act nowadays. And I think this is where the feeder cattle got within about $3 of taking out their September highs in the March futures. We didn't get nearly as close when you look at this CME cash index with that September high back there around 254 and change. This is a key element to the market maybe rolling over potentially and moving lower. And why I like this feeder chart, it's because this cash index is sitting at 246. Oklahoma City reported flat to $2 higher prices unless you went over 850 weight feeders. Then they jumped to about $5 higher on their update Wednesday. What I'm getting at is you've got March futures dancing around 250, and that's after Wednesday's break. We could see the feeder cash index in the cash market kind of pull back on the futures, and the funds do that through the unwinding of the feeder corn ratio. And I think that's a real key element to watch here as I continue to, kind of barnstorm the area and say, get your puts underneath you in the feeders and the fats. We're coming into March. March of 2015 was not a good time for the fat cattle or the feeders. Just have a floor underneath you and see what happens.
Well, let's look at the April feeder daily chart as well, just to kind of echo some of those things you're saying about getting some of those floors and puts in. I would agree with you. I know that some folks may be getting bulled up again here in these cattle markets, but to your point, managing that risk in this window is important because, we could wake up next week and be much lower than where we're at right now, Mike.
Well, and this chart really shows it. I mean, this is bona fide hedging 101. April feeder futures closed Wednesday at 255. We took out the minor trend line support and the red line. The orange trend line is the backbone of this chart. Then you've got a secondary backbone of the major moving average at around, as I call it, around 244. You've got roughly $10, $11 on the table if you take out that 255 support, maybe more. But I think that next trend line, moving average support, is your main support for this market at this stage of the game, Jesse. So let's say you buy a $2 put and you're all wrong and the market goes back up on you. I would think that if the market has the energy to turn and go higher after today's break, then you're probably going to go back towards that 273.75 area high from September of 2023 in the April futures, that 100% Fibonacci line. That's the white dotted line. So if you're risking $2, $2.50 to potentially lose, quote unquote, but then gain on the cash side $20 to $25 of premium in your cash sale as you get into April, I say that's a wonderful hedge in terms of bona fide, take the smaller paper loss and capitalize on a really good gain on the cash side of the equation, as opposed to not doing anything and then sitting at 245 when you're getting ready to market your cash feeders.
That's a great thought. And I heard a story too from someone here Friday or over the weekend. Someone was at a sale barn and they took a look at the quote screen. They saw corn below 4, immediately turned around and called their corn guy. This was a cattle feedlot guy, and got more corn booked for their feedlot. So I wonder too if there's a lot of folks in the feedlot side that are maybe booking some feed here in this window, even with corn slightly rallying right now, Mike.
It's an excellent point. I think it makes sense when the Oklahoma City price is seeing a big jump at 850 weights or higher. That means you've got this low corn price and you can get those feeders into fats a lot quicker and take advantage of these prices right here, right now, both in terms of the corn price and what the fat cattle price is on the deferred. I'm guessing that feedlots are already marketed for spring fats at this point if they're buying 8-weight feeders at $5 over right now.
Hogs too, an okay day there Wednesday. I mean, still watching some $100 summer hogs. Been an interesting market to watch. Kind of claw its way back here ever so quietly, Mike.
Yeah, I'm really intrigued by the export sales, both in beef and pork on Thursday morning, because I'm really itching to hedge and sell into the hog market here with the idea that the big low in China, yes, it's been made, but can we do any more? And as you say, these summer months at $100, it seems to me that the consumption side of the equation, while it should be strong for the summertime in the pork in relation to the beef, because of the retail prices, do we really have much more in it at this stage of the game? So I think at these price levels, Jesse, I'd classify as the hog sector is in a position where you need to feed the bull at this stage of the game, especially in light of the build and the cold storage numbers versus the prior month. I did not like seeing that in the pork side of the equation. Beef was down 1%. Pork actually added versus the last month.
Mike, good stuff as always. If folks want to reach out to you, take a look at your analysis and much more, how can they get a hold of you?
Best way is to go to globalcomresearch.com and globalcom with 2M's research.com. Toll-free numbers on there. Take a look at our product services and see if there's not something there for you.
Mike Zuzolo with Global Commodity Analytics. Great to catch up with you again this week. Thanks for joining us. We'll talk to you again soon.
Thanks, Jesse, and enjoy the heat.
I'm going to enjoy the heat in Houston as much as I can. That's for sure. Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.